The modern financial system, once a cornerstone of societal progress, has fundamentally lost its way. Originally designed to improve lives by facilitating commerce, enabling home ownership through mortgages, and allowing for the prudent management of risk, finance was a powerful engine for growth. Historical examples, like the rise of Britain and the Netherlands, demonstrate how a robust financial sector can fuel industrialization and raise living standards. Yet, somewhere along the line, this vital system mutated. It shifted its focus from serving the real economy, the world of businesses, jobs, and tangible goods, to serving itself through an endless, complex web of speculative transactions. This transformation, known as financialization, began in earnest in the 1970s and accelerated with the creation of exotic new products called derivatives. These are financial contracts whose value is derived from the performance of other assets, like mortgages or commodities. While some derivatives can be used to manage risk, their proliferation created a vast, shadowy market detached from real-world value. Instruments like credit default swaps were sold as insurance against loan defaults, but in practice, they became tools for betting on failure. This created a dangerous chain where the fate of one institution was intricately linked to the potential misfortune of another, all built on a foundation of increasingly risky loans. The system became a high-stakes casino, where professionals gambled with other people's money, reaping enormous profits from complexity while distancing themselves from any real accountability. A crucial driver of this recklessness was a profound shift in culture and incentives within the industry. In the past, bank executives often had their own capital invested in their firms and viewed their roles as lifelong stewards. This fostered a culture of caution and long-term thinking. The modern era, however, introduced the "I'll be gone, you'll be gone" mentality. Executives, now often managing shareholder money rather than their own, were incentivized to pursue short-term windfalls through risky bets, knowing they could collect massive bonuses and move on before any consequences materialized. Similarly, the traditional role of the broker, who acted as a neutral agent for a client, eroded. The rise of broker-dealers meant these entities could now trade for their own profit, creating a direct conflict of interest where they might steer clients toward inferior deals while keeping the best opportunities for themselves. The 2008 global financial crisis was not an unpredictable accident but the logical, devastating conclusion of these decades of misaligned incentives and speculative excess. The collapse was rooted in the trade of mortgage-backed securities, bundles of home loans sold to investors, that were filled with mortgages granted to borrowers who could not afford them. These toxic assets were then passed around the system, insured by those precarious credit default swaps. When homeowners began to default, the entire house of cards collapsed. Banks that had traded these instruments found themselves simultaneously on the hook for massive losses and unable to collect from their counterparts, freezing the entire global financial system. The myth that no one saw it coming is just that: the crisis was the inevitable result of greed operating in an accountability vacuum. The sector's dangerous power is further cemented by its immense political influence. Financial institutions are the largest spenders on political lobbying and campaign donations, ensuring a sympathetic ear in government. This influence was starkly visible in the aftermath of the 2008 crisis, when governments around the world chose to bail out the very institutions whose actions caused the disaster. This rescue, while arguably necessary to prevent total economic meltdown, sent a catastrophic moral hazard message: the largest banks are too big to fail, free to privatize profits in good times and socialize losses in bad times, with the taxpayer as the ultimate guarantor. It undermined any meaningful lesson from the crisis and protected the existing, flawed structures of power. In the wake of such crises, the instinctive response is to call for more regulation. However, the relationship between finance and regulation is fraught. The industry's complexity and political clout often mean new rules are either insufficient, quickly circumvented by financial engineering, or even counterproductive, stifling beneficial economic activity while failing to curb the core speculative behaviors. The problem is not necessarily a lack of rules, but a system whose fundamental architecture encourages evasion and risk shifting. Ultimately, meaningful reform requires a deep structural and cultural restructuring of finance itself. Positive change must come from within, driven by a renewed sense of purpose and ethics. This means realigning compensation to reward long-term stability over short-term bets, resurrecting the concept of personal liability for decision-makers, and simplifying financial products so their risks are clear. The goal must be to tether finance firmly back to its original, vital mission, facilitating investment in productive enterprise, managing genuine risk, and improving the economic well-being of society as a whole, rather than serving as an end in itself.